In today's video, we're going to be going over mortgage insurance on a home loan. We'll be looking at the difference between conventional and FHA loans in regards to mortgage insurance, why you have always heard that you need 20% down to purchase a home and why that's not true. And lastly, this is the most important one, and the numbers might actually surprise you, but it is the biggest benefit to having mortgage insurance. My name is Kadyn Nannini. I'm a mortgage loan officer here in Phoenix, Arizona. I'm also known as the Millennial Loan Officer. You can follow my Instagram and my TikTok right here. But before we kick off this video, make sure you hit that like button at the end of the video and subscribe so you don't miss my next video. But let's dive in. When you think of a home loan, there's two main loan programs that come to mind, and it's conventional and FHA. And I want to talk about how the mortgage insurance percentages and rates, they fall into that. So starting off with FHA. FHA comes with a flat fee, the lowest one being 0.85%. Everyone gets the same percentage on an FHA loan. Regardless of outside factors, that is what you get on that loan program. On the flip side, on a conventional loan, there's outside factors like credit score and debt to income. Those play a factor in what you're able to qualify for, basically saying that if your credit score is better or higher, you will pay less in mortgage insurance. I've come up with this kind of rough metaphor saying that if there's some bad kids acting up in class, the teacher then, punishes everyone. That's kind of like what an FHA loan does. Everyone gets the same treatment. Where on conventional, if there's a couple of good kids with better credit scores, they are treated with better treatment. They have earned that right. That is what having a better credit score does for mortgage insurance. Typically, you've heard or you'll hear 680 credit score or lower. The best program for mortgage insurance would probably be an FHA loan, because on conventional, the percentage might be higher. So it's better to go with that flat fee. But if you have 700 plus, that's probably a conventional loan is a better fit for you, which leaves a gray area of about 680 to 700, where a good loan officer will figure out what's the best loan program for you. Next, just a quick statement to get out that you do not need 20% down to purchase a home. That is a myth that is carried on ever since our grandparents started purchasing homes. But you do need 20% down to avoid mortgage insurance on a conventional loan. But I'm going to go into this next little phase here where I talk about why you don't always need to put 20% down, and it actually could be the financial benefit to you to put less down, like 10%. The biggest benefit to having mortgage insurance in your mortgage payment is actually keeping cash in your pocket when you close on your home. Things happen in life, things come up, repairs happen for homes, things you want to fix in your home. So if you are putting less of a down payment down, it will make your mortgage payment higher. But I'm going to show you why it might financially benefit you to put less down, take on mortgage insurance, and save you money long term. Let's dive into the numbers. So say we're looking at a $400,000 home. You're going to submit an offer and you actually get the offer accepted with a 20% down payment. That is $80,000. So if you were to get a home with a $320,000 loan amount with a rate of about 7% and then located here in Arizona, your payment would be about $2,325. So let's take the same home at $400,000. You're going to put $10,000 down now, half, $40,000 with a good credit score. Let's go with the same rate, and your rough payment would be about $26.94. That's accounting for mortgage insurance being roughly $100 a month. So you would have to take on an additional $370 a month in an overall mortgage payment. So let's say you bought that $400,000 home with a 10% down payment. So let's say as you work down your principal balance over the course of 3 years, your home appreciates at a rate of a very basic 4%. Well, over 3 years, your home would be worth $450,000. That means you'd have about a rough equity amount of about 20% in your home. This is the beautiful thing about a conventional loan, that you're able to drop off that mortgage insurance once you gain a loan to value or equity state of loan to value of 80% or equity of 20%. So you have now paid $370 more per month by putting that 10% down. Over the course of 3 years, that's about $13,000. But remember, you saved $40,000 up front when you made the purchase of the home. So over the 3 years, you technically have saved $27,000 that you've been able to keep in your pocket and not tied up in the home, while also being able to drop your mortgage insurance off in 3 years. So just 3 years later, you have no mortgage insurance, and then you've also kept, net savings of $27,000. That is the true benefit of having mortgage insurance on your mortgage payment. It allows you to continue to keep money in your pocket while just funding a little bit higher mortgage payment if you can qualify for it. I hope you enjoyed this video, and hopefully you learned a little bit more about mortgage insurance and a little bit more about that myth of having to put 20% down. Just looking at the numbers, mortgage insurance isn't always bad. And if you plan to hold the home for 3, 4, 5 years, mortgage insurance can actually benefit you. Thanks for sticking around, and I look forward to seeing you in the next video.